The 10-year Treasury yield acts as a key benchmark for mortgage rates, especially single-family homes. So when the yield rises, mortgage rates typically follow because lenders add a spread of roughly 1.5% to 2% to cover their costs and risks. What we see is that as of late 2025, with yields around 4.1, 4.2% where we're at today, the 30-year fixed rate mortgage rate is right around the low sixes. So that has held steady with expectations of what should be coming down the pipeline. So what these analysts are saying, if you connect those two dots, is that what they expect for the next 2 years is very little movement on mortgage rates. Again, for 1 to 2 years. That's a big note that impacts the housing market in a big way. Welcome. So normally at this point, what I do is hop into some finance industry news of what's going on. And I talk about something like the fact that Jeff Bezos and Elon Musk are trying to put satellites into space and run their AI from space. And we would talk about that a little bit. But today, guys, we are doing the 2026 Investor Playbook. It's dense. It's big. There's a lot of angles. There's a lot of layers here. There's a lot of things we have to cover. So we're going to jump right into it. Speaking of what we're going to cover today, let's go over that. Today, we're going to cover an overall economic review. We're going to cover what happened in 2025. We are going to go through inflation, tariffs, interest rates, treasury yields, mortgage rates, housing affordability, real estate markets, GDP, what the drivers were there. And most importantly, we're going to go into 2026, look at what the projections are for next year, as well as the most important, which is to consider different options and routes that you can go with your portfolio to apply this data effectively. But if we haven't gotten a chance to meet yet, I see a lot of first timers in here. If we haven't gotten a chance to meet yet, my name is Nick D'Angelo. I am president and founder here at Saint Investment Group. I'm joined today by the amazing Saint Investment team. You can see a lot of them on camera now. Say hello, guys. Throw a little wave. Hello, hello. We at Saint, our flagship fund is our income fund. We have over 600 mortgage notes in over 29 states, and that portfolio is growing. Over 200 million in assets under management. We pay fixed returns up to 14.28%. And what we're most proud of in this list is that for over a decade, we have never missed a distribution. We've never missed a distribution, and that's been for over a decade, to clarify there. So I'm blessed. I get to be on stages. I get to talk to great people across the country. And my favorite route to go is right here, these webinars where we all get to chat together and dive into economic and investment strategy and have great conversations. This just highlights a couple points from the last slide. We've distributed over 14 million to our happy investors. We've had over 131 months of consecutive distributions. We're in over 29 states, and we have a great track record that we're really proud of. This is a lot of hard work on the asset management side and the Saint team as a whole. But I always encourage you guys at the stage to not take my word for it. I am biased. I think Saint's amazing. I know the market well, and I think we're best in class at what we do. But most importantly, it would be to encourage you guys to see what investors have to say about us. There are 2 ways that you can find really good investor reviews and get an update of what other people think of us, people that have worked with us. That's going to be Trustpilot and Google reviews. We've got probably, 30 plus on both platforms. So if you're curious, I would urge you guys to check those out. And then before we get too far here, I want to take a moment and introduce you guys to a very important and key member of the Saint team, Mr. Tom Furlong, who is our Director of Investor Success. Tom is extremely seasoned in this industry. He's worked with hundreds of investors, hundreds of millions in dollars invested with them. So Tom, do me a favor. Hop in, tell the audience a little bit about what you do at Saint and how you can help them out.
Absolutely. Yeah, thanks, Nick. So as Nick mentioned, my name is Tom Furlong. I am the Director of Investor Success. Really what that means is I am the resource for you guys to get all information on all things the income fund. So we do a lot of exciting things here at Saint. The income fund we are so proud of, and we are so happy showing it off at all times. I know I've connected with a lot of you already, but if we haven't connected, I would definitely encourage you to schedule a call. We can connect and go through what we offer, right? Our fixed income investment, whether you're looking at retirement, whether you're planning on retirement in the future, whether you're focused on it for beneficiaries, we can go through your exact strategy and how we can help you. So I'll drop my information just in the chat here. And if you haven't already scheduled a call, definitely empower you to schedule a call, or you can just shoot me a text or an email.
Tom, I appreciate that. And again, if you guys haven't gotten with Tom, highly encourage you to do so. Today, we're going to be going over tons of different markets, tons of different asset classes, tons of different economic variables that have big impacts. So if you want to know what Saint is doing and how we are climbing over these hurdles and navigating these interesting things in the market, Tom is a huge resource to get you some insights on those. So thanks, Tom. You have Tom's calendar there as well as direct line. So if you want to fire in a call to Tom, you can do that at any time during our presentation here, or you can book a call at your convenience with what works best. So here's a little outline of what we're jumping into. First, we'll go through a quick legal disclaimer. Then we will jump into the topic. It's dense, it's powerful, it's data driven, and it's really, really helpful. Then we'll wrap up with some housekeeping, and then we will wrap up with some live question and answer discussion period where we can dive into whatever topics that you guys have along the way. So if you have questions that come up, feel free to drop them in the chat. I will answer them on the fly if possible. Otherwise, we will collect them to the end and we will go through them together and open it up for discussion. And I'll give you guys my input as well. And a quick word from our legal team here. I encourage you guys to read this, but here are the highlights. Not investment advice. The things we go through today, we are going through the data behind this, but it's not investment advice. This is for educational purposes only, and all investments, everything we go through today will carry risk. Everything from treasuries to real estate to stocks. Past performance does not ensure future results. Also, I like to plug this in. I'm going to be talking about a lot of numbers throughout today. Some of these are going to be off the cuff. I try to draw connections where I see them to give you guys a better understanding of the different economic variables. So please verify these numbers to make sure that you understand them and that they're accurate, because some of these will be pulled from memory. And then last but not least, Saint owns all the rights to this material. So we request that you guys don't reproduce or reuse any of this, because we want to give you guys lots of good info in the future. And we want to keep doing these and bring you fresh material every month. And last, before we jump in, we like to give books away on these. So if this is your first time, we have a book giveaway. It's our way of doing kind of like a Saint book club, something that we're reading, something that we're diving into with really good information. And right now, this month's book club book that we want to give away for free to you guys is called Any Happy Returns. So Any Happy Returns looks at big, long-term super cycles in things like interest rates, inflation, government policy, etc. These are the big wheels that turn the economy behind the scenes. These are the things that move slow, but they move with power. So this book covers those, not just from a broader perspective, but it also drills down on how they impact us on our daily investments. This is written by Peter Oppenheimer, who is a Goldman Sachs chief global equity strategist. So the guy might know a thing or two about what he's talking about. This book is designed for high net worth investors, but it's also beneficial if you're not as much of a high net worth investor and you're not there yet, because it gives you the strategies that they're using today. So let's talk about how you can get a free book. There are a few ways to engage. We want to hear from you guys to get this free book. The first is going to be comments in the chat. So if you're interested in getting a free book, do me a favor and drop book in the chat now. We can practice here. The next is going to be questions in the chat. Roger, there we go. Michael, Lori, there's some smart people. There's some smart people in the Saint universe. I'm glad you guys are turned on by this book. This is a powerful one. Book. Xandra, Roy, Paul. Wow. Francois, Amanda. Great. The next is responding to polls. We might drop polls throughout this to check in on what you guys think and get your votes on different pieces of the economy. And then last but not least, please Feel free to drop questions at any point in time. And again, I'll answer them personally. It might be at the moment if possible, but if I'm on a thought, then we'll use it for the very end at the Q&A. We will dive into those and compile those along the way. So we also have a QR code. If you got to leave early, you can always buy the book, but we'd rather just send you one for free, right? So feel free to drop things in the chat and let's stay engaged, and we will get you guys a free book for the biggest contributors today. All right, let's kick things off. We'll start it with a dark and brooding slide. Inflation with lots of red on the board, right? For those that it's your first time joining us, we talk about inflation on literally every webinar. I want to be upfront and clear on that. Inflation is always a crucial topic, and it's one that has a lot of layers in all areas of the economy. We're going to discuss inflationary cycles. We're going to discuss the metrics that economists use to track and explain inflation, and most importantly, the impact it has on the overall economy. So I'll let you guys take a second look at this chart. This is historic PCE inflation for 2025. Let's talk about personal consumption expenditures, or PCE. The Federal Reserve is guided by its dual mandate. They have two things that they're tracking. They have a mandate to balance two variables. One is to manage inflation. The target for inflation is 2%. The second is what they call reasonable employment, but the assumption there by economists is typically that they're targeting 4% for the unemployment rate. If they are checking boxes on both of these variables, we have a relatively stable and balanced economy. Now, if you're looking at the numbers at the board, on the board, and you beat me to it, you know that they're missing on both marks. They have not hit either target. PCE inflation remained persistently above the Fed's target of 2% and above their forecast of 2.5%. So they didn't hit either one of those. We started 2025 at 2.5%, and then we had a brief inflation dip in March at 2.3%, but now we are reaching again back to that 2.8% number. The takeaway here is the stickiness of inflation, particularly in core services and shelter costs, things that we all incur on a daily basis. These are the things that kept the Federal Reserve Board cautious when they were cutting rates throughout the year. Because cheaper money, just as a quick economic note, cheaper money means people spend more, and that increases inflation. So at its very core, cutting rates is inflationary. So please do me a favor and keep that in mind when we talk about the Fed rate cuts in a minute here, because that concept is going to be very important. Tariff concerns and elevated energy prices in the middle of 2025 also contributed to the persistent inflation that was above target. The lack of data that we saw throughout this year that appears to make December rate cuts less, or appeared to make December rate cuts less likely. Remember, we had a government shutdown for an extended period of time. So Fed officials cited that the data disruption was a reason that they were having a lot of caution in cutting rates. The October Federal Open Market Committee minutes talked about significant division. This is an important note. What this meant is that many participants suggested that under their economic outlooks, aka the Federal Open Market Committee, it would be appropriate to keep the target range unchanged for the rest of the year. That was the initial note. But Federal Reserve Chair Jerome Powell said after the October meeting, so he immediately followed up with this, this is a temporary state of affairs, and we're going to do our jobs. We're going to try to collect every scrap of data that we can find and think about it carefully. Now, of course, the FOMC did approve an additional 25 basis point rate cut last week, and they cited that it was primarily out of concern of the labor market. Right? So Powell acknowledged that this was a close call and that he could make a case for either side. So this was tight. The decision reflected deep divisions within the committee itself about whether to prioritize employment concerns or to focus on inflation, which was still steady at 2.8%, which is well above the Fed's target of 2%. The vote was split last week. This didn't get enough coverage. Typically, we don't see a split vote on the Federal Open Market Committee. Last week, it was 9-3. There were 3 dissenting votes, 2 of which were to not cut rates at all, and one of which was to cut rates even more. So the Federal Open Market Committee is still divided at this stage. We're lucky to get one dissenting a vote. Last week we got three. The updated dot plot. The dot plot is a chart that shows what the Federal Open Market Committee expects rates to do in the near term, in the midterm, and the long term. So quarterly, annually for the next year, and then 2 years out. They said, let me pull up the exact notes here. The updated dot plot showed only one more rate cut for 2026 and only one rate cut in 2027. The majority of officials agreed on this. So what does this mean? One as of the data that they have today, the Federal Open Market Committee of the Federal Reserve expects one rate cut next year. And in 2027, one rate cut. So two rate cuts in 2 years are expected right now. So to drill down a little bit on PCE, here's a good look at how prices looked in different sectors over the course of the last year. Every sector of the economy always results differently across the board. So this is kind of a good breakdown to see a good spread across. Individual sectors contributed differently to the overall rise in inflation in 2025, but only one sector enjoyed reduced inflation, and that was apparel. And the entire drop there was 0.1%. So it was an inflationary year across the board. Prices went up. On the extreme side, we saw beef go up almost 15%. So I'm switching to chicken, guys. That's the big takeaway here for me personally. But in contrast, we saw auto insurance actually fall, its inflation rate fall, so its growth rate fall from 12% to 3%, while energy prices overall increased by nearly 3%. So let's talk forecasting. What do the big boys and girls have to say about where things are going? In 2026, inflation is expected to range between 2.4 and 2.6%, quoting some of the biggest names in finance, including the Federal Reserve. The basis for these projections include the following assumptions. Shelter disinflation. Interesting. Maybe we'll get to that in a second. Labor market cooling. We will definitely get to that in a second. Energy prices stabilizing. Again, guys, the US, for all the talk about oil and why we do all these different things, we are energy independent. We actually export a lot of oil and energy. So really, energy has never been or has not been our issue since the shale revolution. So that's a good point. That should drive down costs for consumers. We also have tariffs. We also have continued restrictive monetary policy. So as much as I've beaten up on Jerome Powell in the last 5 years, I think he's playing it pretty tight these days and not overcorrecting like we saw in the 2020 to 2024 era. There are also some upside risks. Tariffs again, food prices, fiscal stimulus. Again, from 2020 to 2024, we saw over 80% of every US dollar in history printed. Okay, maybe we overdid it. And by the way, that was 2 different presidents. So no one president owns all of that. We also see geopolitical disruptions. Are we going into Venezuela and starting a war? Are we ever going to wrap up these other wars? Big questions on that side. This one's going to be quick, but I think it's an important differentiator here between CPI and PCE. So quick note here. Before the year 2000, the Federal Reserve relied on CPI, Consumer Price Index, as a standard reference that they used for inflation. And starting in 2012, around 2000, they shifted to PCE for their main gauge. And then in 2012, they started using PCE as the only inflation guidance, as the main inflation guidance that they relied on. The reason is PCE updates use weights more frequently and update their weights more frequently and better captures substitutions when consumers switch to cheaper products. This is largely good. If consumers have opportunities different places, we want to be able to track those and see how they're saving money and what the real impact on the costs and the spending, et cetera, are across the board. So this is a big one. All in all, PCE reflects better how people actually spend their money right now. So I encourage you guys to look at both. I certainly look at both, but PCE is what the Federal Reserve's looking at. So if you want to go on their cheat sheet and look exactly what they're doing, I check out dot plot and the PCE. Speaking of dot plot, let's take a look. The dot plot shows significant division among FOMC members. One member projected rates as low as 2.5 or 2.75 to 3% by year end 2025. That's this guy right here, that little dot, the Lone Ranger of the dot plot for 2025. What we also see is that we don't expect, if you look at the trend over the next several years, much of any movement. We see it moving slightly, maybe some of the dots moving slightly down, but we're not seeing the gradual trend we saw in recent years, in recent quarters. So Jeanette, you know what? That's a really good question. These dots are not predictions on the PCE. These dots are the expectations of the Federal Open Market Committee of what they see with today's data and how that would impact how they would make decisions on rates in the future. So slight differentiator right now. They're trying to stay away probably from crystal ball on the PCE side. Interest rates. Exactly right, Jeanette. Exactly right. So how do investors use the dot plot and use that to apply to investing? One is the likely path of future rate changes. Two is how hawkish or dovish the Federal Reserve is becoming over a period of time. They also look at whether expectations have shifted since last releases. Let me give you a hint. When we were looking at this a year ago, I think the expectation, Leslie's our head analyst, maybe she could pull it up, but I think the expectation at one point was 6 rate cuts. Right? I mean, like it was huge swings on this dot plot. So it's good to get a snapshot at what the Federal Open Market Committee is thinking, but this changes dramatically over time. And then also the last thing that investors use this for is the median projection. This is the consensus view. So middle of the pack, the averages here. We see that if we took a consensus view for the next 3 years, don't see a lot of movement. And longer run, all bets are off. So the Fed projected 2 rate cuts in 2025. What actually happened? With rates ending at 3.75 to 4%. The Fed September dot plot projects rates at 3.4 by the end of 2026. Although a December rate cut was not assured, we saw a sharply divided Federal Reserve. We kind of talked about that. They were divided over the 1/4 point rate cut that we had last week. What does this show? This shows us a few things. First, it shows us that when the data is complex as it is today, that not even the Federal Open Market Committee agrees on the best course of action. They don't even have a crystal ball on this. They're all over the board. They had 3 people that didn't even agree with the rate cut this month. This also shows us the Fed made 3 rate cuts instead of 2 in 2025. So they are acting more aggressively than expected, right? The question here is going to be why. Now, again, the Federal Reserve has a dual mandate on one side to avoid inflation above 2%, and on the other side to stabilize employment around 4%. These are typically a balancing act, like we said. So if they're making more rate cuts than they planned on, then it's not to avoid inflation. It's to avoid unemployment issues. So what we can see and what we can read between the lines on their decision last week to make the 3rd rate cut instead of 2 was that they have larger unemployment concerns going into this month and next year that they're trying to solve for. That's the important note reading between the Federal Reserve lines. Leslie, I see your mic on.
Yeah, I just wanted to add that if you look all the way back to September of 2024, they were actually projecting 4/4% rate, 425 basis point rate cuts for 2025. So then it did change to 2 and then back up to 3. So it's been all over the place as they try to get this under control.
Thank you. I appreciate that. I appreciate the clarity on that. So the big takeaway is the Federal Reserve can be all over the dance floor too. And right now, again, they have high inflation and high unemployment. So they're making decisions on what they see as most key and most critical for today. Looks like they're siding with supporting the labor markets and trying to fight and tamper down unemployment. So let's talk treasury yields. We're getting a little bit into the weeds of finance here, but this will have a big impact on the next section. So we want to set the table a little bit with this discussion. Treasury yields. Let's look at the 10-year Treasury specifically. Projections for the 2025 yields for the 10-year Treasury ranged from 3.75 to 4.5. And in 2024, we saw yields range from 3.7 to 4.7. Kind of the same, right? I mean, we're in the same range there. So not a whole lot of movement. The yield in early December 2025 today is right about 4.13%. So right in the middle of their projections. So they finally got one right. Let's give them kudos. Let's give them their flowers on that. Bank rate, bank rate, which is a big mortgage forecaster, and they have a lot of rates that they compare regularly. They expect a 4.18% yield at the end of Q2 2026, so in roughly 6 months, with forecasts ranging from 3.6 to 4.75. Again, pretty much the same range. Goldman Sachs and their analysts predict the 10-year Treasury will remain near 4.1% through 2027. So the next 2 years, they expect us to stay at the same range that we are at today. So what we see from many of the biggest analysts is that for 2026 and 2027, with the data they're looking at today, we likely can expect very little movement on the 10-year Treasury. Hard stop there. Why are we talking about this? The 10-year Treasury yield acts as a key benchmark for mortgage rates, especially single-family homes. So when the yield rises, mortgage rates typically follow because lenders add a spread of roughly 1.5% to 2% to cover their costs and risks. What we see is that as of late 2025, with yields around 4.1, 4.2% where we're at today, the 30-year fixed rate mortgage rate is right around the low sixes. So that has held steady with expectations of what should be coming down the pipeline. So what these analysts are saying, if you connect those two dots, is that what they expect for the next 2 years is very little movement on mortgage rates. Again, for 1 to 2 years. That's a big note that impacts the housing market in a big way. On one hand, those rates actually look cheaper, on one hand, those that are looking for cheaper mortgages for houses, maybe you want to buy, maybe you want to refinance, you're going to probably be disappointed according to this data. But on the other hand, if you look historically, that 6%-ish mortgage rate is well below the 8% average that we've had for the last 100 years and is largely still competitive if you think about that historically. So with the stable mortgage rate for the next couple years, market fundamentals in real estate will be more important when you're buying homes or you're buying investment properties. I think that's largely positive. We're getting back to the point where the actual asset has to perform. The market has to perform. And we're getting away from bets on rates just going down. I think that was a dangerous trend we saw in a few years with investment real estate. So 2026 yields. With 2026 yields projected to hover around the 4.1% or a mortgage rate of roughly 6%, the road may be bumpy due to some economic conditions along the way. We also have uncertain policy outcomes, and we also have some fiscal concerns. We have broken down the components here to show you guys what is impacting the market and impacting yields in different ways across the board. So here are some things that impact the yields and kind of their weighted average in a pie chart. Federal Reserve actions. Clearly, 100%, we know when the Federal Reserve does something, markets move. It's the biggest central bank in the world. Also, economic data, GDP forecasts, GDP growth, unemployment, manufacturing data, consumer spending, et cetera. All the economic data that goes into things. We see inflation indicators, CPI, PCE, wage growth. We're going to get to wage growth in a minute. That's one of my favorites, one of the things I look at the most. We also see fiscal policy, budget deficit growth. Both sides are really good at doing that lately. Basically, since the Reagan era, we've been on a tear. Actually, Clinton. Leslie, I knew you'd fact check me on that one. We haven't had a balanced budget since Clinton, so budget deficit growth, both sides of the aisle are really good at that. We also have global factors. We have currency movements, we have geopolitical events, trade agreements, etc. All of these things factor in to what the 10-year Treasury yield will do. So why were we talking Treasury yields? Because it very much impacts mortgage rates. So let's dig into mortgage rates and see what the expectations are for those. Here's a great chart. I encourage you guys to take a look along the way and see what mortgage rates have done over the last, since 1975. The average rate for a 30-year fixed rate mortgage over the last 50 years is 7.74%. So comparatively, while today's interest rate feels high because we're used to that like 3, 4, 5% range, they remain below the long-term average. In the 1980s, while the Fed was working desperately to control inflation, this was the Volcker era, this was the stagflation era, right? The average during that period of time, 12.74%, with a high in 1981 of 16.64% for mortgages. 8 feels pretty good in compare, or excuse me, 6 feels pretty good in comparison to that. In the last 5 years, however, the lowest rate that we reached was 3.25% in 2021, and the high that we reached most recently was 7% in 2023. So it's a good historical backdrop for us to lean into. So predictions for 2025 for the 30-year fixed rate mortgage were accurate. Again, another win on the board. For people that were making decisions at the Fed level, we saw that Fannie Mae predicted rates at 6.3%, while the Mortgage Bankers Association forecasted rates 6.4 to 6.6%. So while 2025 started with rates above 7, rates dropped throughout this year, reaching a low of 6.1% in recent months. We're slightly up above that, but we're right about there now. Projections for 2026, with that in mind that they actually were accurate last time. Fannie Mae was accurate last round. The forecast has dropped for next year for drum roll 5.9%. So we get a big 0.2% reduction over the next year is what Fannie Mae is expecting. The consensus across the board, if you look at all the big financial institutions, everybody's targeting the low 6% range. So we can expect that if we compare the last slides on the 10-year Treasury, that there's a 2-year expectation around that 4.1%. And if we look at the expectations of the mortgage rates for the next several years, I mean, a couple factors are pointing to 6% mortgages for the next 2 years. Same thing here, right? You can see some of the expectations. Some expect it to go up, but long-term forecasts are averaging 5.94%. So right about that 6% range. So let's play a game. I think this is a good illustration and it's really fun. Let's play a game using an interesting comparison. Let's compare a moment in history with the highest rates of all time versus the more recent history with the lowest rates of the recent era. Let's compare home prices. Let's compare mortgage payments, and let's make them inflation adjusted so there's no funny business along the way. Home prices and mortgage rates are the two key variables in the affordability equation. Excuse me. In the last 5 years, we've seen home prices increase over 47%. We've also seen mortgage rates double over that period of time. And that's resulted in the affordability crisis that not only did we cover in a recent webinar, but also has made headline news. Thank God we're having that discussion across the American spectrum. Comparing affordability from 1981 with the highest rates in history to 2021 with the lowest rates in recent history, let's compare both in actual numbers and inflation adjusted dollars. And you can see them in the lower quadrants here. These are the inflation adjusted. If you compare the picture for a home buyer in 1981 versus 2021, the mortgage rate was almost 5 times higher in 1981. But due to much lower average cost of a home, again, those are the variables, mortgage rates and the home price, right? But due to a much lower cost of a home in 1981, the home payment was 57% lower. However, if you adjust the payment for cost of inflation, the 1981 buyer pays 71% more per month for a home that costs 45% less. So it's deeply skewed based on home values here. The takeaway here is that home prices have gone up massively in the last 30-year time span, even if rates were higher previously. And the reality is that we still have a 4 to 6 million home shortfall in the US on the supply side. So home prices are not likely to be declining nationally. I'll give that caveat. They're not likely to be declining nationally at any significant amount anytime soon. During the same period, so 1981 to 2021, we also, here's just some fun notes. We also saw that the average size of a home changed from 1,500 square feet in 1981 to 2021 average size home being roughly 2,500 square feet. This also includes the fact that Americans are having less children and family sizes have shrunk over time. So many interesting trends, but the takeaway is that it is more expensive than ever to buy a home today, even with cheaper rates than in 1981, because home sizes have gotten higher, or home sizes have increased dramatically, and home prices have gone through the roof. So let's talk labor market. We're getting into the good stuff here. The labor market has transitioned from severe tightness to normalization, and now we're starting to see softening. So we're seeing a full cycle in the employment market here. Today, the Bureau of Labor Statistics released the delayed October jobs report along with November numbers. The U.S. lost 105,000 jobs in October. We also did add 64,000 in November, while the unemployment rate rose to 4.6%, which, to compare this, is the highest that we've seen since September 2021. The BLS also revised early reports for August and September, reducing the jobs gained by a combined total of 33,000 for those months. The 2026 outlook, now we're going into the future. The 2026 outlook suggests continued cooling in the job market with modestly rising unemployment and slower job growth. The note here, we're still far from recession territory. We're going to go into that in a second. There's a good chart that will visualize this a little bit better. The good note, real wages are growing. They're growing modestly, to be fair, but they are growing after that massive inflation shock that we had the last handful of years. Wage growth is one of the things that we watch for most, especially at Saint, but kind of economically across the board. So when wages are steady and they're consistently increasing beyond inflation, this is a positive indicator for the U.S. families and quality of life for Americans kind of across the board. So it is very important. We'll look at that in a second. But looking at historical unemployment rates, this gives us a really good picture here. The labor market has softened considerably from its post-COVID tightness. Unemployment rose to its current level of 4.4% in September, the highest since October 21, like we said, and a notable shift from 3.4, which was a low that we reached in 2023. The Federal Reserve does not publicly state a target for unemployment. Instead, it does it says maximum employment is the real target, which what does that mean? So what that actually means and what that's understood by economists and expected by economists is in the neighborhood of 4% for unemployment. This is where we assume that 4% number for unemployment is because many people look to that in the economics world. Now, our discussion on unemployment rising is a little less concerning, even though it's scary, and the numbers and the comparison of recent years, it is scary, but it's a little less concerning when you look at the history of the last 40 years. Because on a 40-year timeline, what we see is that today's concerning employment numbers are actually the same as the best employment numbers when you look from 1975 to the year 2000. So in that context, we get a better understanding of why many analysts are saying we're far from a recession with these current numbers, even though they're scary if you just look at the last handful of years. Significant but subtle. I love our titling on slides. I gotta give kudos to the team. With unemployment projected to rise to 4.5% in 2026, workers are likely to remain cautious about job switching. The previous job era, the COVID era trend, was the Great Resignation. What we saw here was that employees saw new opportunities. They saw working from home, working for new companies. They were able to move to low-cost markets, but work in high-paying jobs and make that difference. It was a smart move, and it incentivized employees to switch companies during that time. So we saw the Great Resignation. Now what we're seeing is that this has shifted dramatically. We're now in a tight labor market. From there, we saw that this shifted to what's called today as the Great Stay, where the labor market is much looser. We are seeing many more layoffs. We are seeing people stay in roles longer and that they like the consistency of the role that they're in and the current company that they're in more than the opportunities that are out there in the market because there's not as many. The labor market has been shaken up massively in recent years with COVID and government stimulus, inflation, et cetera. Now we're seeing a more stabilized but weaker job economy overall. The evolving labor trends like back to office are replacing work from home. We're also seeing AI impacting corporate work structures in many industries as well. We're seeing skilled trades seeing a boom after many years of being less prioritized and less interesting in the market. And we're also seeing a devaluing of college degrees. This is one I don't like. Recent hiring statistics of some recent studies are showing that there is no increased hiring rate for college grads versus high school grads. That's mind blowing, right? Especially all of us are of generations where you go to college, it gives you more opportunities. We're just not seeing that trend as much while we see things like the trades taking off into the stratosphere. So we have many questions, more questions than answers here, but we also have major questions on generations in the workforce, and this has longer lasting impacts. For instance, as a case study, millennials had major hiring hurdles in the wake of the Great Recession. On my side, I literally worked for free for multiple years at small family offices just to get my foot in the door. I paid my bills by running a business on the side. Now we're seeing similar hurdles for Gen Z. We're seeing that they are having hiring issues. They are having less entry-level jobs that they have access to that are available today. We are seeing the added hurdle also culturally for Gen Z of having the highest pay expectations in history in multiple pay categories. So all in all, these are employment trends that we're seeing going into 2026. Again, more questions than answers, but we wanted to take a second and identify these so that we can keep an eye on these as we go into the next year or two. Last note here, unemployment levels are the most watched statistic about the job market, but wage growth, particularly real wage growth, is also critical. And again, I've said this already, but it's one of the things that we look most at Saint. So real wage growth. That's a good segue to talk directly about real wage growth. We actually have some light through the clouds here. The bright side of the employment picture is real wage growth. Simply put, in 2025, workers achieved real wage gains over inflation. I try to hammer this home, but quality of life is something that we can oftentimes actually quantify if you look at economic data. This equation looks like wage growth over inflation. As wage growth exceeds inflation, more Americans have more money in their pockets and less financial strain. Duh, right? But it needs to be said. We often see this lead to positive mental outcomes. We see family growth, and we see stronger, more stable economic growth over a longer period of time. But the reverse is also true. We see Americans, when they're strapped for cash, quality of life decline and families decline. We see debt increases, the economy become rockier. We see things overall are typically not as good when inflation exceeds wage growth. That's why inflation is one of the biggest problems in our economy, and our debt ties so closely to that. So to reference this chart here, to get back to the chart, what we see is that real wage growth has ranged from 0.7% to 1.4% during 2024 and 2025, showing that workers are finally gaining purchasing power after the 2021 to 2023 inflation surge, when real hourly wage earnings fell 0.7% from January 21 to mid 2025. This is what we see, and this is what we feel today, right? Inflation was out of control due to government money printing more than we've ever seen in US history. We printed an insane amount of money and inflation exceeded wage growth, and now we're finally turning that trend the right direction. So all that said, now we've set the table, what are the 2026 projections in the employment world? Wages and salaries, which account for the bulk of labor costs, rose 0.8% last quarter after increasing 1% in the April to June quarter. They increased 3.5% on an annual basis. When adjusted for inflation, overall wages rose 0.6% in the 12 months through September, after advancing almost a percent in the second quarter. We are making progress. This is a big win that things are correcting. Here's a quote directly from Carl Weinberg, who's the chief economist at High Frequency Economics. There is nothing wrong here from the Fed's point of view, although workers might be grumpy at slow real wage gains. These data support its assertion that labor costs are not contributing to inflation risks at this time. Positive win for workers, positive win for employment, positive win for the economy. The good news is we're back in positive territory. That's the takeaway here for wage growth. Now, let's talk GDP. Let's dig into the number one measure of our U.S. economic output, which is gross domestic product. So what does GDP actually measure? GDP growth tracks the rate of change in total economic output of a country. It's essentially how much more or less goods and services an economy produces compared to a previous period. So it's a measure of economic expansion or contraction in an economy. Is the economy growing or shrinking? Simply put, GDP growth is correlated with higher employment and higher job growth. Sustained growth equals rising incomes and higher living standards. So both sides of the aisle politically have different ways of approaching this. On the Republican side right now, we see a huge focus on boosting GDP to get out of a lot of our debt problems. I'm a huge fan of boosting GDP. And again, it severely impacts Americans in a positive way. The downside is we need to fix our debt too, and that also drags on GDP and drags on a lot of economic indicators. Also noted here, a higher GDP brings more revenue to the government. That's always nice. They can pay their bills a little bit better. It allows them to support important priorities like healthcare, defense, education, infrastructure. But when a GDP contracts, when it declines, the tax revenue also falls. So this also, for a double punch, this also expands and it increases the need for government support services, unemployment benefits, other safety nets, right? So GDP decline is a big problem and it actually snowballs. So us being on the right side of this is a good thing. What are we seeing as GDP drivers going into 2026? And what are we seeing as the headwinds? Number one, consumer spending. Personal consumption expenditures comprised over 69% of GDP in mid-2025. That's good. This is what we call an advanced economy, right? If you look at growing economies, typically they're focusing on things like manufacturing or, sometimes it's natural resources, like they're mining or doing oil, et cetera. We are a consumer-driven economy that's considered an advanced economy. So seeing that is actually a positive sign. Trade dynamics. A sharp decrease in imports in Q2 significantly boosted GDP. That's good. I'm a big fan of manufacturing in the US. I'm a big fan of keeping US dollars on US soil. AI-driven investment. This one's kind of a double-edged sword. Software investment annualized Q2 rate of almost 200%. Information processing equipment grew 8.5%. We're going to get into AI. We did a whole webinar on this. If you don't want to sleep tonight, watch the AI webinar, okay? That's the only plug for the AI webinar I'll say. Weak government spending. I love when our government spends weakly. I love when they don't spend enough. Jeanette, great question of where to find previous webinars, our YouTube channel. So look for @NickDiangelo, and you can find all of our previous webinars on there, most of them, including our AI webinar. It's jam-packed, tons of good info. I'd watch it after this one if you want some inside scoop on AI and some crazy data on that industry. But back to weak government spending. This is a good thing. When the government spends weakly and they don't spend a lot, that's a good thing. Federal spending fell almost 5% in Q1 and fell almost 4% in Q2. Great. We need to spend a lot more, or we need to spend a lot less, maybe like 30% less, but we'll take the wins where we get them on government spending. GDP drivers. Now let's talk headwinds. Labor market softening. We talked about this. Monthly job growth averaging just 50,000 from July to August, down from 55,000. Bad trend. We don't like to see that. We like a robust labor market in the US, especially with a consumer driven economy. Investment in structures declined 7.5% in Q2, six consecutive quarterly drop. And then Q1 was impacted by California wildfires. Brutal, 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 brutal for California citizens. Here's the segue. I included this last minute, but it's just fun data here. Let's talk about the top states contributing to US GDP in 2025. California made up 14.5% of GDP for the US in 2025, followed by Texas at 9.4%, followed by New York at 7.9%, followed by Florida at 5.8%. So between those top four states, that's a huge share of US GDP centered in four states. Also huge populations, so that is obviously a benefit for GDP for them. But let's compare notes. Let's look at some of our allies here. Let's see how they've been doing lately. Let's look a little more global on this so we can get a better understanding of us in the pack. Quick reminder of G7 nations. Those include US, Canada, UK, France, Germany, Italy, and Japan. Most of the world suffered from the 2008 financial crisis and the 2020 COVID pandemic and massive government business closures that were associated with the COVID pandemic. Overall, the last quarter century, the US has maintained the highest average growth over 25 years. We've also seen more stable growth patterns and smaller fluctuations. So we've been the most stable with the best growth. We've also seen stronger stronger post-crisis recoveries. We've also seen from 2008 to 2009, the financial crisis during that period, the GFC, all G7 countries contracted, with Germany almost 6% contraction, Japan 5.5% contraction. Those are two of the worst. And then in 2020, we saw the COVID-19 pandemic with much steeper declines for many of our biggest allies. We saw the UK lose 11% that they contracted in GDP. We saw Italy contract 9%, France almost 8%. These are the worst of the contractions, but these are insanely big dips. One note here that breaks my heart. You might tie the last name D'Angelo to this comment, but Italy has barely grown in 24 years. Their average per year is 0.56% on average. Is that so shocking when you think about the fact that they have very low hours worked? They have very low engagement in work. They travel massively. They have less children. Their fertility rate, the amount of kids that they have for future generations, is massively low. So not only does it look bad today, it looks bad in the future for multiple generations, something they might not bounce back from. So we see that Italy is basically the bottom of the pack here with their GDP growth. We also see that the UK had the most severe COVID impact. We also see that California alone passed Germany's GDP. So lots of changes that are big wins for the US, but our allies are not faring so well here. That is rough. So overall, the G7 nations overall are not doing great over the last 25-year period, but the US is by far and wide the highest performer and the clear outlier, performing well and consistently. Jeanette, great question. The G7 does not include the Arab countries or China or Brazil. So they're just not in here because we were just comparing G7. So we were just comparing that little G7 block. Happy to beat up on those countries, though, too. We can beat up on all countries. Real estate. Let's dive into real estate. My personal favorite section of this entire presentation. Single family market update. Let's dive in here. The October sales data is... And by the way, we have a poll popping up here. I'll take a pause. Let's take a beat and do a poll together. Let's get some input from you guys and some votes on what you're thinking along the board. When planning for 2026, which economic factor is your greatest source of uncertainty? Number one, the Federal Reserve's next move on interest rates. Number two, the direction of the US housing market. Number three, the impact of AI and technology on jobs and the stock market. And number four, volatility and stock market performance outside of the Mag 7. I'm going to have a sip of water real quick while you guys are voting. Lots of votes. Amazing. Input's great. We get some good insights. Okay, let's share some results. And you beat me to it. How do you always know what I'm thinking? So, first place here, the things that keep you up at night, the biggest sources of uncertainty for 2026 economy. The number one is the impact of AI and technology on jobs and the stock market. Again, we have an entire webinar on this. So if you want to really drill that home, I encourage you guys to take a look at that after we're done here. That's number one. And then we got three tied for second with a lot of wise votes in the mix. The Federal Reserve's next move is tied with the direction of the US housing market, which is tied with volatility and stock market performance outside of the Mag 7. We like to call that the S&P 493 as a little fun joke. What I'd say, you guys want me to give my input where I'd rank these? Happy to do it. If you give me a thumbs up, I'll give you guys my ranking of what keeps me up at night on this list. I would say, okay, we got Tom, we got Jeanette, we got Francois. Okay, let's do it. Here's what keeps me up at night in order here. I would say the number one is going to be volatility of the stock market. Again, we have an entire webinar on that as well. We're going to dig into that about 1% here today, but I'll give you guys a little look under the hood on that side. That's the number one. Number two would be the impact of AI. Number three would be the Federal Reserve's next move on interest rates. I think that they are signaling a lot of what their expectations are. And I think they made huge mistakes. I mean, remember Janet Yellen yelling at the top of her lungs that inflation is transitory, and then inflation was 9.1% 18 months later. Yeah, so my trust for the Federal Reserve is not super high, but I think they've learned from a lot of their mistakes. And last, the direction of the U.S. housing market. If you live in a market that's deeply impacted, we'll cover that in a second. But the majority of the U.S. as a whole, I have very low concerns on that. And Mike, we saw your hand raised. If you drop a question, I can get it in Q&A or hit it now if it's something I can squeeze in. But anyways, let's jump into it. Let's beat up the U.S. housing market and give you guys some input here. The October sales data is an improvement, but supply and affordability are still holding sales well below historical norms. Just a few days ago, data was released showing that home prices declined by 1.4%. Yeah, home prices. There we go. Okay, I wanted to make sure it wasn't sales velocity. That home prices declined 1.4% over the last 3 months. Some markets showed much higher drops, including a 10% price decline in the extreme markets like Austin. Some showed mid-range like Denver, 5%. Price appreciation has slowed significantly compared to pandemic-era surges, with some markets now seeing modest declines. We're going to get into this. We're going to get into the flip side of this. But inventory remains below the 5 to 6 months that is typically considered a balanced market, which means there's not enough inventory on the market. Interest rates of around 6.2 to 6.4% represent a significant improvement from early 2025 when rates exceeded 7%. But it also remains roughly double the sub 3.5% rates of the 2020 to 2021 era. The National Association of Realtors chief economist Lawrence Yun noted home sales increased in October even with the government shutdown due to home buyers taking advantage of lower mortgage rates. What we see, and if we're reading between the lines on the economic data, is that the market is in the middle of a lock-in effect, where existing homeowners with low mortgage rates, right, that 2020 to 2021-ish era, are reluctant to sell and take on higher rates in the market. This constrains supply, and it keeps prices elevated despite the reduced affordability. We're going to dig into this. This is going to be a fun one. The down payment is still an enormous obstacle for first-time home buyers right now. That is the biggest obstacle for first-time home buyers. Multiple factors are compounding this challenge. High rents and student loan debt, without a doubt, it makes it really expensive to live in many parts of the country. It is also more than 40% of first-time home buyers say student loans make it harder to save for a down payment. Now, we also touched on previously that college degrees and high school graduates are roughly having the same outcomes in many different industries right now. So imagine that scenario. I won't over drill down on that, but that's just an interesting tie in here. We are also seeing that many are resorting to extreme measures. We are seeing that 26 are tapping into financial assets such as 401ks and IRAs or stocks to fund their down payments. First-time home buyers comprise just 21% of all home purchases today, which is a low number on the 40-year horizon. So, man, I keep plugging our webinars, but we have one called the Great Wealth Transfer that covers this quite a bit. Will inheritance solve the down payment problem? I'm seeing this consistently discussed. Our note is no, not solve, but should bolster a little bit. Boomers are leaving an inheritance for their children and grandchildren, but it's not a solve for the down payment situation. First, the average retiree age 65 to 74 has roughly 200,000 saved, which is not enough to cover their medical expenses and their other life expenses, plus a down payment for their children. So with boomers and grandparents aging, millennials are likely to receive less inheritance, or excuse me, will millennials receive less inheritance in time to move them into the housing market? The unfortunate answer in many situations is no. But let's look at housing prices and what we can expect for 2026. Most housing economists expect home prices will rise by around 2 to 4% nationally. Fannie Mae is calling for home price growth of just 1.3% in 2026, down from 2024's 4.4% increase and 2025's projection of 2.5% growth. Zillow, well, we'll keep moving. We have a lot of estimates here. We also see mortgage rates. We expect rates to stay we expect rates to stay low by historical standards, but high by recent standards. We expect that Fannie Mae expects that a 30-year fixed rate mortgage to average 6.2% at the beginning of 2026, and that we should dip to the low of 5.9% for the year. So basically, we're in for 6%, like we said previously. Now, new construction. And Lori, by the way, I agree with you, not in California. That's for sure. New construction. Construction starts for 2026 faced headwinds as weaker buying and excuse me. Let me reword that. Construction starts for 2026 face some headwinds. We are seeing record high inventories in some markets, but we're also seeing the record constraints in many other markets. We see new homes comprise 26% of total housing inventory, up from 12% before the pandemic. Sales volume. This is an interesting one. NAR, the National Association of Realtors, optimistically expects 10 to 20% gains in sales in 2026. Any ideas or any questions or any thoughts on why the National Association of Realtors would peg 10 to 20% gain and be the most optimistic in the entire market for their expectations on the next year of home sale volume? Let me give you a little bit of my perspective. I think it's because they have a lot of realtors in their cohort and they want to keep those people working and not looking for other jobs. But I digress. Fannie Mae is much more cautious, forecasting a 7.3% increase in sales in 2026. So not too far off from the 10%, but certainly not a 20%, right? Zillow is estimating roughly a 4.3%. But from a historical perspective, some regions will experience much lower growth, while some will obviously experience much higher. Real estate is always going to be a local industry. That's a positive and a negative, because if you understand the market, there's always opportunities. If you don't understand the market, you can get caught in one of the downsides. California specifically expects existing single-family home sales to total roughly 300,000 in 2026, which is a 2% increase from 2025. Sunbelt states like Florida and Texas are also experiencing roughly the same volumes. But let's talk drivers. Why is this the case? Let's talk a tale of two markets here. The drivers are vastly different in these different markets, and they lead to different outcomes. In Florida and Texas, the oversupply is causing price drops in many of the markets. In fact, 7 of the 10 markets with the largest year-to-year price decreases are in Florida and Texas. Not surprisingly, These areas show price reductions that also have higher inventories. In September 2025, 22 of the top 75 markets had higher active inventory than September's average in 2018 and 2019. Let's take a minute and pause here and let's make the reverse point. We know that we have an affordability crisis in housing in the United States. We know we have a housing shortfall of 4 to 6 million homes in the United States. And we know that many state governments have tried to solve this crisis with every regulation, with everything they could throw at it: rent control, zoning restrictions, landlord laws. I mean, again, we keep going back to California, but I'm a landlord in California. We own houses in California, not by our choice. It's something that kind of just baked into the portfolio. New laws in California for single family landlords are so numerous that it makes it nearly impossible to keep up on a yearly basis. It is never ending. So let's think this through. Are you telling me, Nick, that Texas and Florida are seeing oversupply and a reduction in price and rents while the rest of the country is trying to solve for this problem? How the heck did Florida and Texas achieve that while all other states are creating mountains of new laws and seeing no progress or driving up prices? Well, Florida and Texas got the hell out of the way of developers' way and added supply to the market, right? The more supply, the more affordable housing becomes. It's not more complicated than that. The more supply, the cheaper housing, the cheaper rents become for consumers and people that want to buy and rent. In California, it took 3 planning commission meetings and a city council vote to change a sign for a new condo project we were trying to put in. To change a sign. It was, I don't know, a 6x4 sign, right? Every step of the way, we had more and more headaches and more fees, and everything took more time than it should have. In Texas and Florida, they are creating new housing at huge rates. They are achieving the affordability goal while the rest of the country isn't. So when in doubt, look for economic solutions over political solutions. Okay? That's the takeaway here. As a matter of fact, we literally have a book launch coming out next year for a book that's called Economics Over Politics. Okay? So if you want to learn more about how economic solutions can solve political problems, check out the link in the chat to get an update of when our book goes live. It covers the biggest topics in the US, and it will be extremely powerful, and it looks at them from an economic lens of how we can solve these rather than just beating everyone to death with legislation. Ange, can I ask you to drop a link to our book in the webinar chat? I think they'll like it. I think this is a perfect tie-in. So in contrast, my personal bet is that Texas and Florida will draw in more residents with this affordable housing, and it will continue to boost their markets and their GDP with new residents moving there. In the short term, I do think house prices will continue to decline. I also think rent prices will decline, but I think this will bring in new business, and I think it will create new opportunities for residents over the midterm and the long term. I love California. Again, I'm a resident of California. There are so many amazing things about this state, and I'm also really good at complaining about it. But I see California's solutions to many of the problems as not economically sound, to give an example. My hope is that we solve the housing affordability crisis for all Americans across the board, across the country, and lean into good economic strategies so that we can improve quality of life. So also, you'll see a link to the book. If you guys want to learn about Economics Over Politics, a book we're releasing at the beginning of next year, check that out. It covers topics like this with economic data. It really beats them up, and it gives some really, really good solutions. Lori, great question. Can I answer that in Q&A? I'm happy to drill down on that. That's a great question. So new home inventory. 6 months of inventory is considered a balanced market. Higher inventories put downward pressure on prices. However, inventory impact is altered by the lock-in effect. We touched base on it a little bit earlier. What we're seeing is that 40% of homes are owned by boomers who have no plans to move and no plans to reduce home ownership. We also see that 82% of homeowners have mortgages below 6%. If mortgages are expected to stay at 6% for 2026 and 2027, then 80% will not be incentivized to move on rates alone. We also see that 72% of mortgages in the United States have rates below 5%. And we also see that over half, 54% of mortgages in the United States have rates below 4%. So, how many of those would be incentivized? 54% of mortgages of homeowners. How many of those would be incentivized to move to a 6% rate? Very few. The lock in effect is real, and it's causing a shortage in home sales. It creates artificial inventory shortage kind of across the country. We're also seeing homeowners unwilling to trade the lower rates for higher rates in equivalent homes. The same home is still much more expensive if they move. So this lock in effect is keeping inventory levels below historical norms. We have a great chart showing inventory kind of across the board here. So let's dig in on real estate. Let's beat up different specific segments in commercial real estate. And of course, we have to start with multifamily. So what's the story of multifamily in 2025? Let's call it a year of adjustment. Rents. Advertised rents in the US was up modestly in 2025, a 1.2% increase for the full year. So basically, if we split that out into months, a 0.1% increase per month. The regions with notable disparities. We saw New York City up 4.2%, Chicago nearly 4%, San Francisco roughly 3.5%, Minneapolis roughly 3.5%, roughly 3%. We saw decreases in Austin, roughly 4%, Jackson, 2%, Nashville, almost 1.5%, and Dallas, 1%. Occupancy. Occupancy in stabilized properties nationally slid to 94.4% in March, which is the lowest in over 10 years. It also rebounded to 94.7%, so it rebounded a little bit, not super high. But the high supply markets that we're seeing, Austin, Houston, Dallas, and Atlanta, each had occupancy below 93%. So not too far off from national averages, but we're also seeing that rents are softer across the country. But new units, the last piece of commercial is always the question of how many units are coming online, because as more inventory comes online, it drives rents down. There are more options for consumers and renters. The wave that we saw of multifamily housing starts, construction starts, starting projects from 23 to 24 resulted in record levels of completions at the end of 2024 and the start of 2025. But the pipeline was shrinking quickly through 2025. People did not want to make more multifamily. They saw the writing on the wall and they paused the construction starts. What we saw is that construction starts throughout 2025 dropped roughly 30% back to below pre-pandemic averages. The 2025 total for completed deliveries is over 400,000, followed by 332,000 in 2026 that is expected, and 319,000 in 2027 expected. So regional outlook for multifamily. CBRE, which is the largest real estate company in the world, CBRE expects average multifamily rents to grow by 3.1% annually for the next 5 years. If you were to ask me my bet, I think that's a little rosy considering what we just saw at roughly 1%. But that's what CBRE is expecting. Again, are they incentivized because they want to sell some properties? Maybe like the National Association of Realtors, maybe there's an incentive there. But as the construction pipeline shrinks, what we do know is stronger renter demand is likely. We should see that the vacancy rate and the above average rent growth should be there in 2026. So we should see upward pressures on rent growth. I think that's probably pretty accurate. Do I think it'll hit 3%? Maybe not. Strong performers for a regional outlook. Top rent growth performers will include markets with weak supply growth. So funny enough, the markets that no one wanted to build in previously are now the markets that have tighter supply because they have less new inventory coming online. These include cities like Chicago, Philadelphia, Detroit. Demand for return to office policies are also driving up rent growth in cities like New York and San Francisco. We also are seeing that population growth is being driven by the same factors: Columbus, Minneapolis, Kansas City. So who's on the slow recovery side? The high supply markets, the ones that everyone wanted to be in, have a little bit of a slower upward recovery. We're seeing some Florida markets, Orlando, Miami. We're seeing some, we see Austin and Texas, huge development there previously. That market's balancing out. We also see Nashville and Phoenix. Phoenix, again, this is one of the off the cuff numbers. I believe the metric for Phoenix is that in the last few years, we saw 40,000 units hit the market and only job creation of 12,000 jobs. So the question becomes, what happens to rents? Probably go down, right? There's an oversupply of inventory of multifamily. What happens in the midterm? Probably bring people in that are looking for a cheaper cost of living. Will that increase businesses coming to the area? Will that increase job growth in the area by more people coming into town? Probably, but we'll see. We'll see what happens in those markets. Now let's talk office. Ooh, office is a little chilly. Office is a little chilly. The good news for office is that it appears to have turned a corner late 2025. We have now seen 6 consecutive quarters of positive net absorption, meaning that the market is absorbing a more amount of leases and people trying to lease and businesses trying to lease up office space than it did previously. So the trend is positive in office. We are still seeing some very scary numbers. We see the 20s and the 18s bouncing around, but we are starting to see the trend reverse very slowly. Leasing activity exceeded 5-year quarterly average at almost 60 million square feet in Q3. We're also seeing vacancy declining for the first time in over 5 years. Now, it would be great to say that office fundamentals have completely changed and that now it's just on its feet and it's perfect and things are great. But what we're actually seeing are 2 trends. The first, this is a tale of 2 markets. At the top of the market, we see that 30% of Class A office buildings are fully occupied, and another 20% have vacancy rates below 15%. So they're relatively competitive. What we see is that the bottom 10% of office, though, in contrast, are highly challenged and likely obsolete buildings. These are massively leading to the higher overall vacancy rates. So it looks like in a market with tough leasing, businesses have their pick of which buildings they want to occupy, and they're choosing Class A offices to no one's surprise at all. In October 2025, prime buildings, Class A plus, we're talking 14.2% vacancy nationally. Non-prime buildings, 19.1% vacancy. So tale of 2 markets, to say the least. Also, I'm going to bring up the return to office thing has bolstered some markets, very much so. We're still seeing the work from home trend in many other markets, but you look at, the San Franciscos, you look at the New York Cities, the Manhattans, a lot of that is driven by the return to office trends. By September, the national office vacancy rate stood at 18.6%, which is down 80 basis points over the last 12 months. So with numbers that big, that's not a huge gain, but it is a gain. So we'll give it there. Seattle's seeing a 27% vacancy. San Francisco is still seeing a 28.8% vacancy. Denver at 24.7. Manhattan saw a 4% decline in vacancy in 2025 to 12.7%. That's pretty good. 4% is pretty substantial if you look at this market. And then we also see national projections. The most optimistic by Marcus and Millichap, again, a broker in the market. Maybe they have an incentive, but maybe not. Maybe these are very accurate. Marcus and Millichap projects vacancy will drop nationally to 15.9% by the end of 2026. So progress. I don't know if it's huge progress. If you look at some of the fundamentals of some of the financials of what it takes to run an office deal, 15% is cutting it pretty tight. But here's some interesting trends that would drive positive directions in office. Office construction is reaching 25-year lows, meaning no one wants to build office, right? Office utilization is improving to 70%. Just a couple years ago, it was 50% with the work from home trend. So those are some gains there for the office market. And then we're seeing small gains in space demand offsetting limited new supply. So the rough estimate for next year, for 2026, is that office vacancy will drop meaning occupancy will increase. The vacancy rate should drop to 15.9% if Marcus and Millitrap threads the needle on their estimate. Now, retail. Let's talk retail. I actually started in real estate and retail, so it's close to my heart, but it's also the most difficult leasing in the industry, in my opinion. It is highly volatile and it's super regionally driven. And frankly, I just don't like the tenant mix. It's really difficult. But all that aside, of my personal side, let's dig into the numbers. The 2025 US retail commercial real estate market is characterized by very tight space. We see that modestly rising vacancy versus 2024. So over this year, vacancy actually went up. What we also see is that new construction is there, but slowing. So less people want to build in retail markets. They want to add less retail. It's less of an interesting asset class for developers. What we see is that rents are expected in retail. That Cushman and Wakefield, another big group, estimates that national asking rents for vacant retail space are roughly $25 a foot towards the end of this year, which is up almost 2% year over year. So we are seeing rent growth, but 2024 saw 4%. So rent growth is actually declining comparatively, but we are seeing rents in the positive arena. So let's look at CoStar. So for those that don't know, CoStar is one of the biggest data platforms in real estate. They do have the best data. They have great analysis, and they also are a nightmare to work with. So they don't have a good reputation in commercial and investment real estate, but everybody kind of deals with them. They're kind of like, you have to cross the bridge of CoStar in order to get the best data. CoStar's projections through 2026 call for relatively stable near-term outlook. Slight vacancy increases, so that is going the wrong direction, continued with low construction, so that's positive for retail, and moderate rent growth. Performance is bifurcated. This is, again, a tale of two markets. High traffic, well-located centers are doing better and consistently better, and older underperforming assets are consistently getting more crushed. Back to tale of two markets for retail as well. You can see some of the data here. I don't want to line by line it. Let me take a sip of water, but I don't want to line by line it, but you guys can kind of compare what 2025 looked like and 2026 looks like at the same time. In industrial, if you were to ask me my favorite asset class in commercial real estate, it's far and wide, no question, no second guessing, it's industrial real estate. I can get into all the details. I'll get into some of them here, but we actually are going to release an industrial real estate investing masterclass next year to give you guys real, true line by line of the industrial world and what that looks like. In 2025, US industrial property market is in a late cycle normalization phase. What that means is that vacancy has moved into the mid 6% range. If you compare that to others like 15 or 16%, seems pretty good, right? We're now in the mid 6 to mid 7% range for industrial. Construction and deliveries, what new inventory is hitting the market? These are falling sharply, meaning people are letting the market stabilize. They see that they've overdeveloped certain markets, and that's created looser leasing environments. And they also are moving towards investing in hard assets, standing buildings, et cetera. So money is moving different directions in industrial today. Let me tell you why I believe industrial is the absolute standout asset class of the list that we just went through. Number one, it's the most data driven. Okay. We know that industrial real estate has specific drivers. We can track these drivers. These are very metrics driven. Multifamily, often you have to look at lagging indicators and you have to make future bets. With industrial real estate, you're dealing with businesses. They have balance sheets. We have public companies. We know what they're doing more in the future. We also can look at the drivers of the industries, imports, manufacturing volumes. We can look at shipping routes and the volumes of shipping for trucking in different interstate highways. It's amazing how much data access you have for industrial. So you can target better markets with higher certainty than you can other areas of real estate, in my opinion. We are also the largest consumer country in the world, like we said earlier. So we can accurately track volumes of things like purchases and drive those all the way back to shipping volumes and distribution volumes out of warehouses. So if you really look at industrial real estate holistically, things track to each other. A tracks to Z, and you can find all the letters in between. We also have a better outlook of the impact of construction on the market. Asset classes like multifamily have data that is betting on things like future job growth, future things, et cetera, while industrial real estate can look at which markets actually require and have a deep, longer term need for those assets to bring those buildings into those markets. Not to say they don't get overdeveloped in industrial. We do see that in several markets today, but it's less likely, and it leads to a 6 to 7% vacancy rather than a 16% vacancy. So it's not as wide swinging as other market classes. So industrial vacancy at 6.6% towards the end of this year. We are seeing strong leasing and declining new constructions, which is bolstering up the market going into 2026. Cushman and Wakefield CBRE highlights robust leasing, but confirms that effective rent growth has cooled, meaning a lot of new inventory has hit key markets, but we are still seeing robust and active leasing environment. When the wheels stop turning on leasing in commercial real estate, you know you have a problem. When you're not getting calls on deals, when you're not getting access to new tenants, you know that market has cooled off considerably. So when CBRE highlights robust leasing, I love that for industrial. That's a great place to be. CBRE is also saying that 2025, late 2025, U.S. industrial and logistics figures show an overall industry vacancy. Well, we covered vacancy, 6.6%, with a year-to-date lease up 9.8% increase over year. So it is going better. We are increasing over time, and we are absorbing the new construction very effectively in the industrial space in the United States. I think that's a very, very, very good trend going into it. So what are we showing in the data? We are seeing some good trends. We see vacancy dropping at a steady pace, consistently chipping away at vacancy on the right trajectory. We see that construction is slowing down. We see leasing activity picking up nearly 10% over the previous year. All positive trends. What we're seeing boots on the ground in multiple markets that we work in is in a phase where the market is stabilizing well, and we're expecting a climbing positive 2026 with an even much stronger 2027 expectation. All of these are very positive numbers when you look at this graph. That said, is it perfect? No, nowhere in commercial real estate is perfect right now. But if I was going to be putting money in commercial real estate, it would be industrial, no question. Let's talk AI. It snuck its way in on multiple points in this. Again, we have a webinar that deals with a ton of deep dive on this, but let's dig in on the highlights of AI for 2025 and what that looks like for 2026. AI is hitting the US economy less like a new technology and more like a natural disaster with sticker shock across the board. What we're seeing is that in a matter of quarters and not decades, it's ripped through different balance sheets, business models, labor markets, while the real consequences and the real impacts, pros and cons, will probably take years for us to really, 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 truly understand. So let's frame this discussion. Lori, yes, absolutely industrial is my favorite hard asset in real estate right now. I still like mortgages better as a today asset. I like investing in single family homes better, in that market. But I think industrial for hard assets, commercial real estate, absolutely. So winners, losers, and complexity in the marketplace. AI is not a rising tide that lifts all boats. That's what we know for sure from the data. What we're seeing is a reshuffling of different productivity and who absorbs which parts of which disruption. That is yet to be seen, but we're seeing it more and more in different areas and really understanding AI more fully. What we're seeing is that others are becoming, or that transaction velocity between AI providers, cloud platforms, chip makers, data vendors, et cetera, are amplifying the uncertainty. We're not sure where those are going and where the future of the industry goes. Today, we have Elon Musk announcing that he's taking AI to space. So there are so many blind spots with the AI world. But here's some data that can help us sort through this. Most importantly, because we're on an investment webinar here, let's talk about how AI is impacting investing. Any discussion of the impact in AI and tech on the economy starts with the Magnificent Seven, the seven companies leading the S&P 500. We're talking Apple, Microsoft, Amazon, Alphabet, Meta, Nvidia, and Tesla. The Mag 7 have recovered from their Q1 lows. They got their butt kicked early in this year, saw some drops, and are now slightly ahead of the broader index year to date. Okay, so they've picked up some steam. What we're seeing is that they've gone from being the primary driver of market returns, which is bad. I think that's largely a bad trend. But what we're seeing now is that they're in line with the market. That's good. Stocks are getting more balanced. They're not relying on seven companies. The rest of the market, which we like to call the S&P 493, has significantly closed the performance gap compared to the 2023-2024 era, where it was basically just the Magnificent Seven. The key question moving forward is whether this represents a healthy broadening of the market, or is this the beginning of a more sustained reversal for mega caps in the market space? Let's dig into some things that keep me up at night with the stock market. The Magnificent Seven accounts for 35% of the value of the S&P 500 as of mid-November of this year. That's nearly 3 times as much as in 2015 when it made up just 12-ish% of the market. But how does performance compare? Let's dig into the numbers there. In the 2 years between 2023 and 2024, the S&P 7, aka the Mag 7, outperformed the S&P 493 by 6 times. They truly carried the stock market during that period. The S&P 500 during that time would have barely registered a gain without the Magnificent Seven over 2023 and 2024. 7 companies saved the stock market for 2 years. That scares the crap out of me when looking at stock market data. For 2025, the Magnificent Seven has year-to-date returns of 14.2% compared to the S&P 500's 13.4%. So that gap is closing. So, is AI a job killer or is it a gold mine? Is it the future of jobs in general? For context, the layoff numbers noted are a small portion of the whole because we got some good news and bad news on the board. Total U.S. layoffs exceeded 1 million in 2025, with October marking 153,000 job cuts, the highest October total in over 20 years. So depending on where you look, the experts bet that AI is destroying jobs or that it's also a turbo boost for employment. And there's cases for both sides, actually. Based on the data, both can actually be true in different ways. AI is both creating and destroying jobs, but the impact varies significantly by the sector and the job type. The bottom line, AI is creating high-paying specialized roles while simultaneously reducing and eliminating routine positions. The net effect so far shows that job creation is outpacing displacement. AI is creating more jobs than it's displacing. What I'll note here is that if you look at major technologies throughout history, internet, printing press, automobile, they've created more jobs than they've taken away. Doesn't mean there's a lot of pain in the meantime, but the net is positive typically. The data suggests from AI that this is an ongoing transformation rather than a completed shift with significant disruption likely all the way through 27 or 28. So who's getting hit the hardest with AI? We see that marketing consulting, graphic design, office admin, and telephone call centers have fallen below trends amid the reports of labor demand due to the AI efficiency gains in these areas. Also, we're seeing young workers, back to Gen Z, they are disproportionately being impacted by AI. We're seeing that unemployment among 20 to 30-year-olds in tech is being massively beaten up. We see a 3 percentage point loss in that since 2025. However, also we see jobs are growing in virtually every AI exposed occupation. Obviously, there's huge gains there. We're seeing companies grow on the back of AI. So we see overall, including roles that are, overall in companies that are AI exposed and AI integrated, we're seeing a job growth rate of 38% from 2019 to 2024. So big gains for companies that are including AI. Speaking of stocks, let's dig in a little bit, huh? So what did the market tell us? What did the stock market tell us in 2025? The US equity market posted another strong year in 2025 with S&P 500 total returns running moderately above long-term averages and valuations stretching further above historical norms. So returns were good, but maybe we're overvaluing some companies. Again, we drilled down on this in a recent webinar. I'd encourage you guys to check out. Here's one of my biggest concerns on the stock market. We've mentioned this a couple times here, but the stock are on different webinars, but the stock market is actually shrinking. Most people aren't aware of that. Okay. The number of companies in the stock market is shrinking year over year over year. And this trend has been ongoing for an extended period of time. There are 4,300 publicly traded companies in the US today. That is down from 7,300 in 1996. For many reasons, emerging companies are choosing to wait much longer to go public or to never go public. I think it's more of the latter than the former. So what does this do to us as investors? This limits the opportunities that are available to everyday investors. It also makes the stock market less diversified over time as less companies are going public, which means we have less access to those companies. When we look at the data like the Magnificent Seven that makes up 35% of the S&P 500 value, we see that the market is getting more concentrated than ever with less companies for us to diversify with in the equity stock markets. A recent example is the private offering made this year by OpenAI, again, a private company. They sold 40 billion in stock that was issued, but only available to fewer than 50 invited investors. This is the type of activity that creates a two-tiered market, which the ultra wealthy, the already wealthy, the insiders have access to opportunities like these, while the rest of us have less access to those best opportunities and less stocks that we're able to invest in the stock market overall. So what does that mean? That means if you're in stocks, we urge you to be cautious and diligent and to consider diversifying your portfolio into hard, real assets. I personally believe, this is not scripted, I believe that private investing is the future here. I believe that more companies are staying private and the best opportunities in the future will not be in public companies. I think there'll be private investments. I think this gives us as investors access to smaller companies, companies that are maybe generational family HVAC companies, things like that. But I think those mid-tier companies that are not going public are bigger opportunities than a public market that's declining constantly with a 35% concentration in 7 companies. That's my bet. That's what I see when digging into the data. But what is Wall Street predicting? Let's see what they're predicting about their own progress for 2026. Most of the large banks and strategists are calling for the S&P to end 2026 somewhere around the 7,100 to 8,000 range. What this means for us as investors is roughly an 8 to 16% upside return from the current levels of the forecast. But remember, this is equity investing, meaning we as investors, if we invest in the stock market, take the bulk of the risk of market fluctuations. There will be highs and lows. This is not fixed income. So you're looking at 8 to 16% is what the expectation is for next year and the roller coaster that goes along with it with all the things we just talked about. One note here is the danger in deteriorating economic fundamentals and the overly expensive valuations. Again, we have charts and graphs that we beat up on this specific webinar, but stock prices in key indices remain near historic highs relative to earnings. What this suggests is little margin for error if growth ever slows. What this suggests is you're already prepaying for their income on the front end. So if they go backwards or they need to adjust to new market conditions, the likelihood is a decrease in stock value. If you look at things like, again, this is not scripted. I'm going off the top of my head with just some different notes that I constantly look at. If you look at things like the CAPE ratio, the cost adjusted price to earning ratio, then what we can see is at one point in the market recently, we were looking at stocks being considered 38% overpriced, meaning if they dropped 38% in value, they would be considered a fair price. Okay. So now it's no wonder why Warren Buffett, the best value investor in stock market history, can't freaking find things to buy. And he's sitting on hundreds of billions in cash without a place to deploy it, is because value investing is not a mainstay of today's stock market. So, what options do you have here? Our goal when we dig into all this economic data is to achieve one outcome. It's to give you the tools to put together what we like to call an all seasons portfolio. That's a portfolio that's balanced, that as the markets go from different season to season to season, that your portfolio continues to perform. In the past, it was simple: 60-40 portfolio, 60 stocks, 40% bonds. We did a whole webinar on this. The coupling of stocks and bonds where they were negatively correlated, that is broken. The 60-40 portfolio only existed for several decades because of the influences of the economics at that time. We are not in that environment anymore. So the future, I still like the concept. The concept is this: you have opportunities for growth and you have opportunities for fixed income. The fixed income gives you stability and the growth gives you upside potential. So if you're choosing wisely on those two fronts, you have pretty good opportunities there. At Saint, we lean heavily into the fixed income component. That's the part of the portfolio that we want to solve for people. So fixed income in this market, the biggest thing we see from investors is they choke on the 4.1%, the 4-ish percent treasuries when inflation is almost at 3%. That's priced for perfection also. So what I would encourage you guys going into this new market is to consider alternative investments, because the stock market is frothier than ever. CAPE ratio, the Buffett ratio, the overweighting in the S&P and the Magnificent Seven, and the biggest opportunities in the future by many of the biggest groups, BlackRock, Blackstone, etc., are leaning more heavily into alternative assets. Where they used to take 5 to 10% of their portfolio, they're looking at 30 to 40% of many of their portfolios towards fixed income and real estate, all things backed by hard real assets. So that's what I would tell you that we're seeing as the best foundation of an all seasons portfolio going forward. And as an investor, all the data we looked at here, all the different angles and things to consider here, optimizing your investments, getting the best cost-adjusted, risk-adjusted investment return. That's what we're talking about here. And then diversification. So if one investment has a bump, you have plenty of assets to back that up. You have a portfolio of assets to back that up. So let's say you are looking at something like an income fund. Our number one bet in this market, Lori asked earlier, so I'll just put it on the nose and answer her question directly. The number one opportunity that we see in this marketplace today is single family homes. There's a 4 to 6 million shortfall on the supply side of single family homes. We have, I think over 80% of mortgages in the US are below 6%. We have 54% of mortgages in the US that are below 4%. We have over 60% of homes owned by boomers that have no plans to move in the near future. I think the stability of single family homes is the most rock solid in this environment that we're at today. The reason we invest in mortgages when we choose that avenue for the single family home market is because owning single family homes and managing those is a nightmare. We have over 600 mortgages that back up our fund. If we owned over 600 single family homes, the asset manager of that would be insane. It would be unscalable. So instead, we invest in the mortgages. So we still get to invest in that single family home market, but we invest on the cash flowing asset behind the home, 30-year mortgages. So that gives you guys an idea of, if you're looking at something like an income fund, they should be thinking long-term into the future. Single family mortgages, we're talking 30-year mortgages, pretty good track record and pretty long investment strategy. One thing that I like about single family homes in this market is that if rates do go up, the number one question we get is what happens to single family home mortgages if rates go up or down? If rates go up, mortgages are more stable because people are locked in. They have that lock-in effect. They want to stay in those homes. We have more equity than we've ever had in the history of single family homes today. So people don't want to lose that equity. They don't want to move and they don't want to pay higher rates. We also have less refinances in the portfolio in the events that rates go up. So we're fine with this scenario. Cash flow is more stabilized. There's less turnover in the portfolio, etc. And on the flip side, if rates go down, fantastic. Again, we're investing super conservatively on the mortgage side. Our average targeted LTV is 55%. So the homeowner, I think our last purchase was 43% LTV. So oftentimes we're beating that. If rates go down, it stimulates buying, it increases equity, it stimulates investment into the housing market. At the end of the day, it increases refinances, which boost our returns also. So we're very okay with that. If we wake up and buy a discounted mortgage and they want to send us the full check up front, our returns go up very high. And it's very simple on our side. We just reinvest that into more mortgages. So for all those reasons, to me, with everything we went through, the single family home market is the most stable with the biggest upside in the future because of that supply crunch, especially. And I like the mortgage aspect to it. So if you want to learn more about investing into the Saint Income Fund, not only is Tom standing by, Tom or Ange, can you drop Tom's contact information into the chat so people have that top of mind? But you can contact Tom. You can book a call with him. You can call him now, any of the above. But Tom will give you a great breakdown of what we're doing specifically in the single family mortgage market. Thank you, Tom. You got Tom's info there. And how this can get you returns up to 14.28% with our model, with some case studies, with some breakdowns on that side. And then we got a couple questions on this. I've referred to several other webinars. If you guys want to check out past webinars where we do the same kind of deep dive, this deep economic dive, very data driven, very dense with some really good insights. We cover things like investment strategy, portfolio strategy, economics, et cetera, et cetera. You can check out topics like these on our YouTube channel. It's 100% free. We're already doing the research, right? We're doing it for our own investing. So we just want to give it away for free. We put these together so that you guys can see what we're working on and what we're looking at.